Hello and welcome to Retire to a Life You Love podcast with your host, Michelle Gessner. I'm Wendy McConnell. Hi, Michelle. How are you?
Hi, Wendy. I'm good. How are you?
Oh, I'm good. I'm good. Now, we're going to be talking today about the big question that everybody always has. Can I retire? Am I ready? Is it time? Can I pull the trigger?
Yeah, that is the question. That's what people want to know. The ultimate question: can you retire? So that's a topic we want to dive into today.
All right. And there's at least 6 points that we're going to go over,
Yep.
and that should help us determine whether we are in a position to do that. Correct?
Yes, ma'am.
Okay. So the first question on the checklist is, do you need professional help with your investments?
Yeah. So there's a lot to say about that, but I'll do my best to just kind of boil it down. First off, the main driver of success with investments is diversification. And you can research that nobody disagrees about that. So if diversification is the primary driver of success, then the question is, how do you know if you're properly diversified? So I'm going to delve into that a little bit. Just having a lot of individual stocks doesn't mean you're diversified, and I find that tends to confuse people. So, yeah, just because you have 50 stocks and they're all different companies, that doesn't mean you're diversified. Correlation is key. So you would have to be able to tell if your portfolio has low correlation. Also, let's say you don't have individual stocks, you have a mutual fund, a bunch of mutual funds or ETFs. You'd have to know what's in those funds to be able to tell if you have low correlation. So, the first thing you'd want to know to answer that question is you want to have a variety of different asset classes that are not highly correlated. So that means you'd have to know what the correlation is between asset classes to put together a diversified portfolio. Now, you may be wondering, what is an asset class? An asset class is a category of securities. And I'll give you some examples. You've got real estate, that's an asset class. You've got small cap US stocks, that's small company US stocks. You've got large cap growth, that would be large company growth type stocks like Amazon, or Google. You've got large cap international. I could keep going. There's about 9 asset classes. So what you would want to know is if the group of holdings that you have high correlation or low correlation. You want low correlation because that's what diversification is. You don't want them all to move together in the same way so that you don't have high highs and low lows, especially low lows. We don't want that.
Right.
Now, you may want preservation of principal. Maybe that's more important to you than getting higher returns as you get closer to retirement. You want to have different industry sectors. That's part of diversification. What's an industry sector? Like technology, that's an industry sector. Energy is an industry sector. Financial services, there are a whole bunch of those as well. So you want to have different industry sectors, different asset classes, different geographical locations. We don't want everything in the United States. We don't want everything in Europe. We don't want everything in any one geography because this is an international global economy, and you want to have representation in different geographies because there's different political climates, different legislation, different currencies. So, we're not saying you want all international, or maybe you don't want very much international, but you shouldn't have everything in one type of a stock or asset class or geography. And then, of course, you want a number of different companies. And what people don't realize is you might hold, let's say you hold 5 different mutual funds. Well, what if those mutual funds tend to hold the same companies? They have a
Oh,
ton of overlap. You
right.
don't know if you're diversified. So, what you'd want to be able to do, if you want to do this yourself, is have the tools and the training to understand these things. And it's especially key to have the tools. You also want to have the time. because you'd have to be able to assess this as things change all the time. Mutual fund managers change their mandates and do different things. Um, you would want to be able to take care of this on your own if that's what you want to do. You also want to enjoy this. So do you enjoy it? Do you have the time? Do you have the tools?
No,
Um,
I do not enjoy it. I definitely need professional help.
yeah, but people think that just looking at some headlines on the news or watching CNBC or going with what your brother-in-law told you or having a little bit of knowledge is good. And some people think, oh, well, I have a whole bunch of different stocks. That does not mean you have diversification. And so you could have lots of mistakes that are being made, which we're going to talk about in a little bit. But I do want to touch on one other topic that comes up when I ask people if they want professional help, and that is fees. Nobody likes paying a fee if you don't have to, right? Because the idea is, well, if I pay a management fee for professional help, that management fee I could be saving and then I'd have higher returns, right?
Mhm.
Well, that is not necessarily the case. That assumes that the professionals um, don't, well, let me put it this way, that you could do just as good of a job as the professional managers could do. And that is often not the case because you don't have the tools. You don't know what correlations are. You don't know how to put these together so that you have a higher return versus risk ratio, which is all based on correlation and diversification. And what's interesting there is that Vanguard did a study on this. It's a pretty famous white paper that they did called "The Value of Professional Investment Advice" or Advisor Alpha. They call it that as well. And this research paper is going to be listed in the show notes if you want to read it. And basically, the gist of their research, they were trying to answer the question like, is it worth paying a fee to an advisor? That was the question. And what they found with their research is that the investor who did things themselves made less money over time. Their return was lower than the folks who used professional advice and paid the fee. The fee was included in all of this, and the professional portfolios tended to do better. And they quantified it. I think it was about 3%. But you can read all about that. Of course, there's never any guarantees, and I'm not making a guarantee here. But I think it's worthwhile looking at that research and how they compiled that conclusion.
Now, when it comes to investing and all of that stuff, a lot of people use their employer's retirement vehicle, such as the 401k, and that's how they accumulate their wealth. So,
Yeah.
is that what you should be doing? Should you keep all of your money there?
Well, you're going on to question number 2, and I want to tackle that, but I just cannot close question number 1 without my favorite expression that I want to give.
Okay, I jumped the gun.
I know, no, you're good. You're good. So here's my closeout for question number 1, which is, can you do this yourself or do you need professional help? All right, now this is my take on it, so just letting you know, but the favorite expression I have on this topic is a lawyer who represents himself has a fool for a client. Got to say that.
Yeah, and I was bracing myself because I knew you were going to say something along those lines.
Yeah, and think about that because you don't know what you don't know. I love when people say, "Oh, I'm doing just fine," and I always like to answer that with compared to what? You're doing just fine compared to what? Because if you don't understand these concepts and principles, how can you answer that?
Mhm.
All right. I'm sorry. I just had to throw that in. You had another question for me. What is it?
I did. Is it a good idea to keep all your money in like your employer's 401k that that you contribute to while you're working?
Yes, yes. Okay. So a lot of people have 401ks or 403bs, some sort of employer retirement plan, which is great. A great place to save money over your career. But now the question is, should you keep your money there? It's a very good question. There's a lot of information about that, but I'm just going to tackle a couple of things here. So first off, once you hit age 59 and a half, that's a magic number for 401ks because a lot of plans allow you to move the money out of the plan while you're still working. You don't have to be retired or separated. You can roll that money out to an IRA of your choice outside the 401k and still participate in the plan, still make contributions going forward. And that is called an in-service distribution. Um, some people call it an in-service rollover, and that means you're still in service. You're just making a rollover or a distribution. It's not a taxable event unless you keep the money. You're rolling it to another IRA. And so this mechanism allows you to start moving money out of the plan while you're still working so you can do some things with your money. All right. So before we answer this question, just understand if you even can. If you're not 59 and a half, you probably can't. Um, if you are 59 and a half or over, you'll want to call your plan folks. And the best way to do that is just use the phone number that's on your statement. They will know. And the question is, can I make an in-service distribution or rollover? And they'll know if you can or can't. That's a plan rule that your company either allows or doesn't allow. So once you find out if you can, so now the question is, well, should I? So let's look at that. One of the things that I urge you to think about is, does your company offer a variety of different choices in your investment lineup that you can use to create the diversified portfolio we just talked about? So do they have all these choices that allow you to represent different asset classes, different industry sectors, number of companies, and geographies? What I have found in looking at lots of different 401k plan lineups is that sometimes they're not very good. They leave out important asset classes. It's impossible to build a diversified portfolio because of the choices that they give you, which are often given by an HR representative that maybe doesn't understand all this. Now, you might have some good choices. It depends on on what you've got there. You could have a target date fund, and those are not uh, usually those are diversified, but there's other problems with those. So it just depends on that, but also the expense ratios. And I don't know if that's a term that you have heard, Wendy, or if I should define what that is, because I know that's
Yeah,
kind of jargony.
let's dig a little deeper on that. Yeah.
So if you have a mutual fund or an ETF stands for exchange traded fund. If you have that in your 401k, which that's usually what they offer, there's going to be an associated expense ratio, is what it's called. All that means is the cost of that fund that is being charged and you're paying for it. The investor is paying for it. It's coming out of the return before it's even posted on your statement. So if you have a bunch of high cost funds with high expense ratios, then that's going to cost you more than if you had the same type of fund that has a lower expense ratio. And what I find is that some company plans, again, put together by folks who maybe don't understand this, like the HR folks, not to pick on them, they have a bunch of high cost, high expense ratio options or funds. And so if that's the case for you, maybe you shouldn't be in that plan if you can get out, right? And just participate, but then move your money out as soon as you can and do something that's less costly and more diversified.
I have a question that I kind of want to go back to a little bit. You're
Sure.
saying that some plans will not allow you to take the money out before you're 59 and a half. Does that mean if I go to you and say, I want you to manage my money before I'm 59 and a half, that you can't go in there and check on that stuff because then you don't really have access to anything in the plan?
So, good question. I can, as your advisor, I can look at it and help you, but only indirectly. I can't directly manage it because I don't have access to your plan. I'm not going to get your password. That would be taking custody. Advisors aren't going to do that, nor should they. So I'm only able to help you as often as you send me a statement. And then I can't execute the trades for you. I can't pick what I think is best because I'm limited, just as you are, to what's offered by the plan. So it may be impossible to build you a diversified portfolio with what we have limited, limited choices.
Okay.
Um, yeah.
So
So
basically what I
that,
heard you say is,
mhm.
"Don't worry about it, Wendy, you really don't have any control anyway."
No, and well, you do have control when you're 59 and a half. And the
Right.
question was, should you or should you not move the money out? Now, if you can't move the money out because you're not 59 and a half, or they don't allow you to do that, well, sure, you have to do what you can. And I maybe saving in the plan is the best thing for you because of all the advantages of a 401k plan. But you have to do the best thing that you can with the limitations that you're under.
Gotcha.
But if you can get out and do something better, why would you not do that?
Exactly.
Now, there's another consideration here that I want to touch on, and there's more. I'm not covering them all, just a couple of considerations, and that's tax diversification, which is a huge topic because as you get closer to retirement, one of the things that scares the retiree is taxes. That's something that it's an expense, and lots of things scare retirees, but tax, and let's face it, taxes scare everybody, not just retirees.
Right.
um, but tax diversification, do you have it? Do you have different kinds of tax titles? Is everything in the 401k, everything's pre-tax, tax deferred, never been, you never paid taxes on this money? That would not be tax diversification. Maybe you want to have some money that's been converted over to Roth, which is tax free, um, and you don't want everything in tax deferred because that money is going to be subject to whatever happens to tax rates. And when you turn the age that triggers required minimum distributions, RMDs, then you're forced to take money out of that tax deferred account, and it lands on your tax return at the then rates in effect, um, the tax rates that are in effect. People get shocked at how much tax is due because of an RMD that they didn't see coming. So, the only way to protect against rising taxes and high impact RMDs is by doing some Roth conversions. Well, you can't do a Roth conversion a lot of the time if your money is sitting in the company 401k because many plans do not allow for Roth conversions. So, in order to get proper tax planning, proper tax diversification, it's important to roll that money out of the plan and start working on that. And again, I have to add, that doesn't mean you're not participating anymore. It just means your existing balance is now in an IRA of your choice.
Okay. I like it. I like it.
Yeah.
So, here's the main question I think that everybody wants to know. Do I have enough money? Can I do it? Can I retire?
Everybody wants to know. Everybody wants to know that, right? How much money do you need to have accumulated to retire? So, to answer that question, that is the crux of what I do, right? We want to figure that out. What do you need to retire? So, to answer that, we have to know how much money you spend in your lifestyle, the lifestyle of your choice. So, if I don't know what you spend or you don't know what you spend, it's going to be much more difficult to answer. So, we've got to know that. And if you lead a fairly modest lifestyle, the answer for you is going to be much different than the person who lives a lavish lifestyle. So those questions I see sometimes in headlines, what do you need to retire? Is it 1 million? Is it 2 million? It's not a cookie cutter answer. So what we need to do to be able to answer that question for you is to be very clear on where your money is spent. So I tell people to start tracking how they spend, maybe for a month or two, if not longer. Now you can do that a couple of different ways. You can use an app like Monarch Money is one of them. YNAB, which stands for You Need a Budget. Mint used to be a choice, but they don't. I don't think they're around anymore. So you can use an app to start tracking. Here's what you really need for your lifestyle, or if you don't want to use an app, just look at your bank statements and credit card statements for the past 2 or 3 months, and you can get a good idea of how you spend your money. We're looking for categories. How much do you usually spend for groceries? How much do you spend for this, that, and the other? And then we can figure out what you need each month for your lifestyle. Um, so that's where it begins. I know it's a tedious exercise, but it's there's no way around it. We have to know that in
It's
order
just
to come up with a good
necessary.
answer. It
Yeah.
is. So once we have that number, then we're going to figure out, well, how much money should you have stored in an emergency fund? How much money should you have stored in a conservative set of investments? And then how much in more long-term growth style vehicles that provide an inflation hedge? You don't want everything in CDs. I can tell you that right now. And the reason why, I mean, it seems like CDs are paying a pretty, decent rate of return right now. What is it, 4 to 5%? But long term, if that may not be a very good inflation hedge, not like what you get from stocks. Well, stocks tend to scare folks in retirement, but we're not talking about putting all of your money in stocks. We're talking about putting the long range money in some stocks for inflation protection. So, in order to be able to come up with what's best for your lifestyle, your risk tolerance, your preferences, it starts with knowing what you need for your lifestyle. So, how much do you spend? And then we can figure out what you need for 1 year, 2 years, 3 years, and get it right.
So we were talking about tax planning before. How do we actually know which strategies to use, and if we're missing anything, so to speak?
Yeah, so that's a good question to ask yourself. What applies to you, and have you done any tax planning? Because I mentioned that's a big consideration in retirement. Um, so we have to first understand what strategies are out there, and then we figure out what's applicable to you. Well, one of the strategies that you've heard me talk about on this show, um, more than a few times, is Roth conversions. And that's a popular tax strategy because it helps you take control of your tax bracket, right? Once you've converted that money to Roth, you're done paying taxes on that money. And if it grows, doubles, triples over the years, doesn't matter. You're not paying another dime of tax during your lifetime. So it's a great tax strategy, and it'll help you with those high impact RMDs that are going to come down the pike for you, for all of us. But we have to be careful that we understand what the unintended consequences could be, such as the impact to your Medicare premiums when you turn 65, the impact on net investment income tax, which is something you'll want to avoid. Um, you don't want to just hope that you're doing the right amount of Roth conversion and hope for the best. Um, Hope is not a strategy, right? I mean,
No, it's
we
not.
we use a little more methodology. Another tax strategy is donor advised funds, right? So maybe you're in a high tax bracket right now, you're still working, and you want to do some Roth conversions because you understand the future benefit, but you've got the sting of the taxation that comes with doing Roth conversions. Well, maybe we can pair Roth conversions with a donor advised fund if you're a charitably inclined person or you're planning to give to charity anyway, either now or in the future. So that's something that we look at doing for clients. But yeah, Roth conversions is a big one. Now, before I move on, I just have to tell you about a couple of cases that I saw across my desk not that long ago. I mean, very recent, um, that will kind of illustrate how this area is just neglected. Uh, it just is. I had a new client whose money was left completely unattended in this area by another advisor who they were working with prior to coming to work with me. And that advisor let a golden opportunity go by where the client was in the zero tax bracket, had no taxes to pay 1 year, and yet the advisor did not do a Roth conversion for that client.
Oh,
And that Roth conversion, had they done it, would have literally cost them nothing to do. Nothing. I mean, they could have done like $100,000 Roth conversion and
how
paid
do
no
you even get
taxes.
into a zero tax bracket?
Yeah, well, exactly. I mean, yeah, I'm not going to be in one. And hopefully, you won't either. I mean, that's not something you definitely, usually a zero tax bracket means that
You're
you
not
don't have any
working.
money. Right,
Right.
but in this person's case, they just had a lot of write-offs from some land that they owned. So they were in a zero tax bracket.
Okay.
Now, that being the case, I was just astounded that that opportunity was lost.
Mm.
Then a second case, very similar to this one, they had a write-off for a different reason, zero tax bracket. Again, nothing was done. Nothing. This is not good financial planning. It's not. Now, the other thing I want to bring up is 2022. Maybe you don't have the luxury or advantage or disadvantage, however you want to look at it, of being in the zero tax bracket. But what about the market decline of 2022 that we all found ourselves in? That was a really great year to get a Roth conversion in because the valuation of the same securities that you held was about 15 to 20% lower that year because the market was down. So you'd be paying a lot less tax on a Roth conversion had you done it that year. But if advisors aren't doing tax planning, and many of them are not, then they didn't advise you to do anything. Or maybe you're just doing this by yourself and you never really thought about it. So that was a year that was lost, a lost opportunity that you could have done a Roth conversion if it made sense in other ways for you, and you would have paid a lot less tax. So that's the cost of not working with someone who's doing tax planning like our office, or not working with anyone at all. And I'll tell you, your CPA is not going to do a Roth conversion for you. First of all, Roth conversions are due by the government by December 31st of each tax year, and or each calendar year, I should say. December 31st. When do you send in your taxes to the CPA?
Usually not until the following year.
Right. February, March, April.
Right.
So, or even later than that. So the calendar year 2022 or 2023, that's gone. That opportunity is lost by the time your CPA is looking at things for you. So they just don't help you in this area. They can't. Um, so definitely want to look at this every year with a qualified tax planning type of financial advisor.
Has your retirement plan been stress tested for things that can go wrong? This is something that a lot of people don't think about that is very necessary.
Yeah. So if you're doing your own financial planning, which I do not recommend, as my little quip earlier in the show would indicate, but if you're doing it yourself or you're using an advisor who really is not giving you the full picture, then you probably haven't had anything stress tested, because it's one thing to project if what are things going to look like if everything goes according to plan. You work until you decide to retire and your health is perfect and everything just goes to plan. That's great. But what about if things go wrong? What if one of the spouses in your household passes away prematurely? What impact does that have on the financial stability of the other spouse? What about long-term care expenses that could come up for someone in your household later in life when a lot of your money's been spent? Um, what's the maximum each year that you really can spend before your plan no longer works or is you're not in a good place? Um, what if taxes go up? That should be tested. That's a stress test we do on everybody's plan, because we do think taxes are going to go up. So we want to see, hey, does your plan work if taxes go up? Um, and then the last stress test I can think of right now, this is not a exhaustive list, but another one is, what about liability? What about risk? Is your money protected against various threats out there? What amount of your money is protected um, against, I don't know, a liability lawsuit? You go driving and you hurt somebody and your insurance pays what it pays, but it's not enough. A variety of different things could go wrong. We want to make sure your assets are protected. So those are just some of the stress tests that we run.
And finally, basically what the entire podcast is about, you have to know what you're going to retire to.
Yeah, and we've spent a lot of time talking about that in the last few episodes. What are you going to do with your time once you're retired? Have you done the self reflection? Have you figured out what you're going to replace the activity that you've been spending so much time on, such as your job? What are you going to do with that time? What's going to keep you feeling like you have purpose to get out of bed in the morning? What's going to bring you happiness? So these are questions that require a little self reflection. Um, I encourage our listeners to catch episode 17, which was talking about this very subject, discovering your purpose in retirement. And episode 16, we talked about turning your hobby into a passion. That's an episode you might want to check out. But I also have a couple of resources for our listeners in addition to our podcast episodes. Couple of books that I think are really good for people to read and use to help them answer that question. And that is So You Think You're Ready to Retire by Barry LaValle. Very good book. I've given that out to several of our clients. And then another book called Retirement Heaven or Hell, and it's written by Mike, and I do not know how to pronounce his last name. It might be Drac or Drake, Drak. Retirement Heaven or Hell. So I encourage people to order that book, take a look at it, and see if that helps them answer that question, because that's something you do not want to forget about. It's not just about finances; it's about what's going to make you happy.
Life, right? It's about life.
It's about life. That's right.
Yeah. Great information, Michelle. Thank you so much. So, how can people get in touch with you if they'd like to, ask you a couple more questions?
Yeah, if you want to make sure that you're retirement ready, or talk about anything you heard in this podcast, or maybe some other topics, just reach out by visiting our website, GessnerWealthStrategies.com, and you'll find our contact information there. And we'd love to hear from you.
All right. Thank you so much. And thank you for listening today. Please like, follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.
Thank you for listening to Retire to a Life You Love with Michelle Gessner from Gessner Wealth Strategies. We hope you were inspired to take steps to your financial freedom as you learned new techniques and strategies for managing your finances. To learn more about how you can improve your financial landscape, visit our website at www.gessnerwealthstrategies.com. That's GESSNER wealthstrategies.com. Or give Michelle and her team a call at 713-589-6448. And don't forget to click the follow button below to be notified when new episodes are available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Michelle Gessner or Gessner Wealth Strategies. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.